Can I say only 10% companies work or 5% companies work, 95% do not work?
I'd say probably 3 works well, 3 okay, 4 may not work that great. That's probably the ratio. We try to be more advisors to the founders. We want to be there to provide advice, to be able to share our historical perspective, to give them the network they need to reach, provide the resources they can connect into.
What qualities a founder need to have in order to make a company successful?
I always emphasize to the founders that they need to be outside in versus inside out. That just means they need to understand what problem they're trying to solve, not just building a product to solve that unknown problem. Mainly, I started my career actually as a C and C++ compiler developers on mainframe. That was how old I am.
One founder superpower you wish more of your portfolio companies had?
Customer focus.
Ray Wu, welcome to the show.
Thank you for having me.
Ray, I've seen how beautifully you progress your career from starting your own company, moving on to Cisco, becoming a managing director at HP Ventures, and now the managing partner at the Alumni Ventures. Invested in so many companies from seed stage to Series A to Series B as well, giving small checks to large checks. Tell us, what do you look for in founders when you invest in them?
Yeah, I think the founders are different stages, right? So it depends on where they are. I think the earliest stages, the founder tend to be very creative. They're curious. They don't believe in the status quo. They're looking for something to change. So they have a passion why they want to do certain things. So a lot of these kind of curiosities, the aggressiveness in terms of how you can build something better. So that's innate almost. So that's essentially almost like a very creative type of person who's looking to change the world. Then over the years, then if you look at different stages, right? The second stage, the founders, they come into Series A and Series B. The founder tend to change a little bit to aggregate other founders into the equation, which is more systematic executors, right? So these are the so ideally we're seeing a group of founders that can, as a team, that both have the creative side, but also have the execution that brings something into the reality beyond just a visionary, right? So that's kind of combination as a founder. So we love the founders that not have a passion, have a belief what they want to change, what the future looks like, and have the execution capability to bring that together, and have the charisma actually to work with the ecosystem that everybody want to work with them and brings this into reality. So there's many factors, but let me just stop here and we can chat more around that.
What's more important to you when you invest, the product or the founder?
I think depends on the stage of the company, right? As I mentioned, at early stage it is founders, because it is more about, because we cannot have the kind of the data, right? The more the company develops, the more data it has, the more customer validation it has. The beginning of the company is all about the founders. It's about why. I mean, you look at, we can ask the question, right? Why they start, who they are, what they are trying to do, right? The 5 questions normally, you can apply that, try to figure out why they start something and whether they're a good fit for that problem to be solved.
So founders market fit is more important than product market fit?
I think so. I think in the beginning for sure. Because the product can change over time. Even you look at Slack, right? Slack, the founder wasn't trying to do Slack in the beginning, right? Then they tilted. It still works. I do think the capability of the founders is to continue to figure out what the problem to solve and then figure out the best path towards that. So there's no fixed to that path, especially within the venture world, especially when it's early. When it's really early, there's no formula. a lot of time they have a hypothesis, we have a hypothesis, we're trying to come together with that, what that vision could be. But it could change over time. The next year something happens, then they just have to pivot. So this kind of pivot is very much depends on the founder's capability to navigate within this ever-changing world, right? So that's why in the beginning I do think it's very much a founder to market fit. But over the times, it could become more of the when the data's, I mean, the system built, the teams together and they can execute. More and more becomes the product in addition to the founders. So you actually can see whether the engine is working, right? It's not just the Rambo who's going out and attack everything. As they already found the path, it's the army attack that systematically to be able to win that battlefield. So I think that's very important over the times where this kind of founder to product transition could happen.
And how does your firm helps founder apart from money, or companies apart from money?
Yeah, ours is what we call network power VC, right? So you think about it, we have about 850,000 community members from more than 25 university alumni networks. So these are big connections, not only into I say the connection that can help the founders to find employees, advisors, even board members. It could be the connection into a company that they want to reach out. So a lot of these are just connections, right? That's one area. The second area is we are very proliferate in our investment cycle. So we are very active. We're probably one of the top 3 most active VC fund in the US at this moment. So we do 200, 300 deals on a yearly basis. We have 1,600 portfolio companies. So which is great for founder to tap into, almost like similar to a YC, right? So you can actually get into our system, and then we have a back-end CEO service team that actually connect founders with founders. So which give them a platform to reach out to other founders to build an ecosystem. So that's great for them as well. So I do think this kind of network effect is very important in this day and age, because not only you want to have the right people reach, but you also want to have the ecosystem built around your product, or have some of the channels that you want to reach out. So it brings this kind of 360 type of human connections, the ecosystem connection to the table.
How do you ensure that you have a good pipeline of ideas and founders coming in to you for partnership?
For us, because we have been so active. Actually, we are in many companies. The founder like us, they will do referrals. We're a co-investor model. A lot of lead VCs, because we don't compete with them on deals. We actually complement them based on not only the check size, but also the speed and also the connections, the network we bring to the table. So they like us to be on the cap table. And then as I mentioned, we have a large community. So a lot of times they will refer the company back to us. A lot of them are, because our alumni networks include top universities from Stanford, Harvard, MIT, Berkeley, Columbia of the world. So they tend to have good network connection within their alumni as well. So a lot of deals, they like to, for example, they see their friends as doing something. They say, well, maybe I can help. And they can essentially refer to us. They can invest through us. Sometimes we bring syndication together, and then they can participate in our syndication. They can put money into the company. They're more willing to help the company. There's many ways, essentially, that our deal flow comes in from multiple pipelines.
What qualities a founder need to have in order to make a company successful?
Yeah. The quality, I think it really depends on the space, and really depends on the timing of the company, right? So I think some of the new areas, as I mentioned before, I invest in a lot into blockchain, AIs. These are new spaces. People may not have the existing formula. So the founder need to be very creative, need to understand the customer needs, need to be able to have the technical capability to develop product, but also need to have the capability to connect with the customers, figure out what problem they were going to solve. So a lot of these is a combination. The earlier it is, the more I say product centric the founders are, the later it is, I think it's the sales. But I always emphasize to the founders that they need to be outside in versus inside out. That just means they need to understand what problem they're trying to solve, not just building a product to solve that unknown problem. A lot of times the customers have its own unique needs, but they may not be the current, they may be the current needs, but may not be the future needs. So you look at Steve Jobs, be able to think about beyond that, says I can create a need. So there is many characters of the founders. So sometimes they're visionary founders, not only. So you need a type of person who can essentially stand on the ground to walk and talk to the customer, sell at this moment, but also have a vision where the future could be and bring that together, right? So essentially, I think that skill set is very hard to find. Once in a while, we see a great founder like that, say, "Hey, that's great to be able to have that skill set completely." And then their team need to be complete. Also, that because a person cannot have all the skill sets, so that's why I do think a founding team matters. But the top founding leaders to be able to have that charisma and to be able to have that vision is very important.
Beautiful. Ray, when you were a founder in Net Beyond, what were your superpowers? What were your core skills?
I was a technologist by training. It was mainly, I started my career actually as a C and C++ compiler developers on mainframe. That was how old I am. Um, so I was trying to figure out what problems can be solved and then what technology can enable this new. At that time was just a transition into the PC, transition into the internet, right? The reason it's called Net Beyond is very much internet beyond the network, right, into the internet. So that's the whole name about. So the whole thing is about developing the capabilities that actually connect everything together. So it's the technology enablement of that. I always believe in the technology. I always believe in the power of something that can change over time. And then so as a technologist, it's all about from a technology innovation perspective. I guess that was I wouldn't call it superpower. It's more about trying to figure out where the technology can fit into the overall paradigm of a business at that moment.
And you from Net Beyond, you sold the company to your partners and moved on to Cisco, and then from Cisco you joined HP Ventures. How did that transition happen from Cisco to HP Ventures when you actually began investing in companies?
Yeah, HP was, I say Cisco was a great place. I joined Cisco truly on the internet wave, so the timing worked out great. I watched the company grow from 8,000 people to 50,000 people when I left. So that was a tremendous
Wow.
growth. It's a great learning opportunity. I ran a consulting business in Asia Pacific. I transitioned into merger acquisition investment in the software space. I did some incubation for Cisco as well. So it was a great, tremendous amount of opportunity. But I was looking for something a little bit bigger to run. I mean, to run the whole venture operation. HP tend to have become that, almost have that opportunity. And then I finished my EMBA at that moment, so I was looking for a change. So timing works out. So that was a great moment. And then HP has multiple businesses. In addition to, I mean, HP has not the true networking business, but essentially computing and storage and consumer business in parallel, right? That has multiple printer. It used to be number one. PC was doing very well with acquisition on Compact. And then there's enterprise business is still very strong even today. So I think it has all facets of a technology platform, where Cisco is very networking centric. So it's just as a bigger platform, it's very interesting. Give me a chance to talk to not only my own investment merger acquisition, but also go out and partner with many VCs, build a network as well.
Uh, in general, when a VC is investing into a bunch of companies, let's say when a VC invests into 100 companies, can I say only 10% companies work or 5% companies work, 95% do not work?
I'd say probably three works well, three okay, four may not work that great. That's probably the ratio. Um,
Okay.
that also depends on the stage of the company. The earlier it is, the more likely that the ratio will be higher towards not working. The later it is, the likely, right? So that's kind of the reason I do think it cannot map into these days is such a wide spectrum of investment stages, right? So certain VCs, the growth stage VCs, that number will be different. I think the trade-off is more around the outcome versus the failure, right? So I mean, VC always says you can only lose one times the money, but you can make 100 times, right? So the mathematics all about some the outcome that is so big that potentially covers everything, right? The later stage of this is already proven, then you don't expect very large multiples. That's why PEs is bigger dollars, smaller multiples. Where early stage, the earlier you go, the more multiple it is, then the more failure it's going to be. But again, from a probability and portfolio construction perspective, that's how it works out.
Beautiful. Now, when you are taking, let's say, taking on LPs who are investing into the fund, on average in the US, VCs are able to give what kind of returns to their LPs?
I think really depends on. I think there's the VCs are essentially as a class as basically on track. I say with the public market probably a little bit better over the years. The longer the cycle it is, the better it's supposed to be. So I do think that VC as an asset class has been proven in the last 20-25 years as a unique asset class. That's kind of the reason why you start to see even Trump is talking about putting private company into a 401k, right? So it's I think the a lot of times the smaller companies stay private, or I say private companies stay private for much longer. 10 years ago, when I was, 20 years ago, when I started in the VC journey, a lot of these VCs, a lot of startups actually go IPO after 4 years, maybe 400 million valuation. These days, you take multiple billion dollars. ChatGPT wouldn't go IPO, right? So, this is the asset class that just so I think this overall structure has changed over the years, and the return parameters also is I think shifted over time as well. I do think that VCs as a long-term asset class is attractive and not correlated with the public market. And I wouldn't talk about the performance per se. It really depends on the funds, right? Our model is co-invest with the well-established, we call well-established VCs. So think about Sequoia, Kleiner Perkins, A6EZ of the world. Most times people want to build a portfolio. They want to get into these kind of top tier, I would say well-established VCs that actually are very much into their games, and most of the times as a limit partner especially, our community is very much individual investors, so very hard for them to get into investing with these VCs, and minimum sometimes tickets $1 million, right? So it's very challenging to a certain degree. So we enable that for our investors to be able to get into these kind of assets, and to co-invest along with the well-established VCs to have exposure on a portfolio basis, on a year-to-year basis.
If you can tell us the structure in a VC firm, like the partners, general partners, LPs, what rights they have, and do partners in a VC put their own money as well to invest into the companies through the VC firm or not? What's the structure?
Probably normally as a GP LP structure, right? So it's so LP invest into the fund companies into the fund. GP would essentially make decision, right? And to be able to deploy that capitals on behalf of the LPs. GP normally put money into the fund. Our family members put money into the funds. Friends put the money into the fund. So it's typical of that structure. But so nothing. There's nothing unique about. This industry has been there for a long time. So I think that's pretty standard across the VC industry.
When you are putting money, you mentioned that like, out of 10 companies, 4 will not work, 3 will be okay, 3 will be doing pretty good. What do you learn from, let's say, these 7 companies? 4 not okay, 3 okay. What's the pattern here? What's common between them, between these 70% companies?
Um, I think come down to a founder and product market fit, right? Or founder market fit to a certain degree. We already talked about that. It's more about, I mean, everything has hypothesis. So the earlier it is, the more you're betting on certain trend will happen. But trend may not stay on that for a long period of time. Sometimes it is a really big move. Everything really works out, right? Internet tend to be that way. Quite a few companies work out in the end. Big wave carries a lot of things. So we're looking for big wave. We're looking disruptions. I think as long as the disruption is big enough, there is a lot of possibilities in that. That doesn't guarantee the outcome. That just means there's a possibility, right? So otherwise, if you look at startup, how would the startup win even in the traditional world? It's very tough. They start from nothing. They try to disrupt. If there's no technology disruption, no market disruption, it's very hard for startup. So that gave so then if hypothesis that if all this is going to we have to project forward, so as well if disruption is coming along to this dimension, and if it works, then that's essentially the outcome. So there's several possibilities why it doesn't work. One is the founders. I think they may not, they think about it as glamorous industries. They like to get in, they like to call themselves founders. They want to be in that mode, but I don't think they know how much they need to sacrifice to make that work. So a lot of these also, I mean, that's one tend to be one dimension, but also they may not be ready um, for putting the team. So that's why I say a lot of times one is very early, 1 to 2 founders. They talk about their vision, but they may not be able to executing. So that's another common issues. Then we also see a lot of times that as the cycle need to match because when the exit, so we tend to, as a VC, we'll kind of think about what potential is going to be, right? I mean, we can build a great business. That's a long term, and certain businesses we do build. And then there's also a kind of more of the momentum carry certain businesses that in this cycle, if you don't catch it, it's very late. So they had to actually come in at the right moment to be able to get into that. So I think the execution speed is very important for the founders. Sometimes they're very systematic. I wouldn't say it's bad. It's just at the timing of that. Certain times requires much faster execution. Certain times it requires more thoughtful execution and build up the barrier. So really depends on time. So I think VC is very tricky. So if you look at historically what worked, if you just bring it over here, it may or may not work. Even the founder may not work, right? I think it just happened to be the timing, the opportunities, the founders, everything all come together. So it does takes a lot of, so I think VC is more of art. We look at all this, we have some historical background, and we look at patent and we try to figure out, hey, that seemed to work well last cycle. Then you need to figure out what has changed in this cycle. And then you try to predict whether the change and the last cycle, which one you take more, and then you try to figure out the right founder, whether that, so I think a lot of these, it just, there's a dynamics that we try to balance on a daily basis. And as a portfolio, you try to get more winning opportunities, but then if it's everything already seen, the return may not be as much as people thought, because most controversial type of startup get the biggest return. So also you need to have outliers. So this outliers requires more creative thinking, creative betting, I wouldn't say betting, creative investing into them. So it takes a little bit more thought behind it as well. Yeah.
How much of it is gut versus data? How many of these decisions are like gut based? You know what? My gut says I want to put money in this. Data might be saying something else, but my gut says. So, do you trust your gut? Do VCs trust their gut?
Um, the later it is, the more data driven. The earlier it is, the more gut driven. Right. I mean, the more innovative it is, not proven, is gut driven. The more proven, or then it's so there is certain things that's evolution. There are certain things are revolution. Revolution tend to be more gut driven, and you tend to want to see, and but that reflect to numbers as well. So a lot of times when something does work, it tick ups very fast as well. The question is, there are several tick ups, right? There's could be user tip up may not I mean, then you say, hey, that should translate to revenue, but that may or may not translate into revenue, right? And that can becomes a barrier entry, but may or may not be. So a lot of times it's over time, it's very much important to look at data. Always validate. I think trust but validate is important. You kind of says, well, I have a gut feeling this should work, right? And then you need to figure out where the signals over time. But then that's why we do I say multi stages of investing, right? It's not like we put in one shot and that's it, right? So we do invest in company in the C stage, we watch it, and if it goes well, the signal looks right, we do Series A, we do Series B, we continue to put money into the company. And then that's where the number comes in, right? You can't be gut across the board.
Makes sense. Ray, one more question here. What increases the chances of a company to succeed? For example, let's say if a company that $1 million of ARR, and if a company is selling to enterprise only, what increases the chances over $1 million ARR plus X plus B plus C? What are those things?
Yeah, I think one is the product, one is the IP, one is there are several things, right? So if you think about product side, the replacement cost, so not only the AR, but also how hard is it to replace this product. I think B2C and B2B are very different. You're talking about B2B only, then B2B in many ways, one is it had to show the success to the company. So you think about what most companies measure. They measure the revenue increase, they measure customer satisfaction, they measure cost savings, right? So there's a bunch of areas they measure. So those are areas that you actually need to show that you are actually bringing value to the customers. And no longer just initially you will see they're selling, but the ARRs or recurring revenues come in because you actually bring value to the customer. So the quality of the revenue really matters in one side. The second is, I say, the replacement. So to a certain degree, there's certain product just so integrated within customers' services or their the internal systems or their ecosystem, whatever that is. It takes a lot more work to bring somebody in, to trust them into the enterprise environment, and to be able to give them all this access and data. So certain areas that once you're in, you pretty much can expand, land expand. I do think that type of companies will have a lot of value because it's not something that can be replaced easily by a competitor. So that's another areas. Then if they have certain IPs, know-hows, and that's something that's a patent as a unique defense capabilities that actually bring into the equation, I do think that matters as well. So there's multiple areas that we look at, and B2C is a little bit different, but B2B, there's quite a few things that I think company is willing to. I mean, from a strategic perspective, I mean, I was in Cisco at HP. We do so a lot of there's strategic synergies, right? So I think if you think about where the exit could be, that's a lot of the strategic areas, who they partner, how their ecosystem build out. Those kind of things also matters quite a bit from how you look at a company, B2B company.
In 2025, what is a moat? Is money a moat? Is IP a moat? Is execution speed a moat? What is a moat?
Depends on the sectors. I think, again, it comes down to a sector, right? 2025 is, I think, shaping to be more the AI. Everybody talk about that. So that seems to be the top of mind for everyone. So let's just look at AI itself. Otherwise, if you look at deep tech, that's totally different. That's again, right? So AI drives a few themes. And then because this wave is so strong and everybody coming in, so I do think speed matters in this case, especially in the beginning of every wave. The ability to go in and grab customers, the ability to go out and find the product market fit and execute very fast, have that execution cultures. I think that matters quite a bit. So that's one area. It matters. IP does matter, but I think really depends on the stages of the company. A lot of times IP build out over time. Some of these, it's if they're application driven, I think in many ways it can be one or two features that essentially looking at where they can fit in the overall equation. I think a lot is know-how. If you look at speed, sometimes IP takes time, and you basically try. It could be we see a lot of universities spin out, for example, that tend to be more IP driven, right? Though that's have a uniqueness. Then YC tend to be more application driven, right? So they build something that just work and get a lot of customers and build the know-hows, build the, I think the other dimension I mentioned, the hard to replace and all this kind of customers values along that. So those are, it's a little bit different. I think it really depends on the type of companies.
In the last couple of years, especially Ray, we don't need too many people. We don't need hundreds of people to do the coding now. The coding can be done with 5-10 people team. Do founders require less and less money now?
Yes, and that has not just the last few years, actually, from the internet onwards, actually even from PC onwards, the costs come down, right? It's just more, it's easier and easier and cheaper to build a startup. It used to be you need all the money, VC money, going into what? Going into buying the hardware, the network, the storage, the computing, getting the people, right? So I think these are just the baseline costs that every business requires. I think over the years, as becomes more easier. I mean, you look at AWS, right? You no longer need to buy the servers, build out data centers yourself. You can essentially rent it. So this kind of renting services coming along, I think really helps in the previous wave. Now I think with AI is even more so because AI brings almost a kind of co-worker, co-pilot into the equation. So even from a person perspective, you're reducing the overall cost on human labors. So now I just think that it's easier and cheaper to start a startup these days. Um, it's harder for them to find, the competition would be more because of that. And then it just need to be the fighting is getting stronger. I just think to be able to go out and find a customer, to be able to win that because there's more choices. I just think from a supply demand perspective, supply is definitely increasing exponentially over time because of that. And the decision factors is not just, it's not money, right? It's actually in many ways it is coming down to just be able to find the right problem to solve. I think more and more this kind of, to be able to understand the customer pain point, to be able to solve the problems that, or to be able to create something that is a unique within AI world. For example, we talk about AI. So just like YouTube create a lot of creators. I mean, this is not industries existing, right? So before YouTube, right? Suddenly there's a new industry suddenly create and people make tons of money. There's a lot of content created. I think AI brings new possibility as new industries coming in, right? Not only it changes the industry, it brings new industries. So new industry tend to move faster and easier just because there's nothing existing. Old one you need to reshape, you need to change, so it takes a little bit longer. So that's why from even investment themes, we're looking at new ones, new areas that are actually just something completely nothing there and it's new. and make it really interesting for us. Versus just going back to change the existing industry. Although that I think that will happen, it just take a little bit longer.
Beautiful. Thank you so much, Ray. Ray, so in this scenario where founders will need less and less money, VCs have a lot of money. Do we have surplus of money and less founders for the money to be deployed in? Do we have surplus money, and what will happen to the extra money that's currently sitting with the VCs?
I don't know if it's going to be actual money. I think here's two scenarios. One is there's just multiple startups coming out and they all need some money, even though it's cheaper, they all need some money. So you do see a lot of angel investing, early stage VCs coming in, right? That wave is actually pretty visible in the last few years.
Okay.
Second, I think once you have your product, to have the product stand out, to be able to win the enterprise customers, doesn't matter it's B2B or B2C, right? B2C, you need a brand, you need that networking effects, and you need to build the mind shares. That takes a lot of money, right? By itself, it takes a lot of money. The building the channels, to be able to reach out to the marketings, that takes a lot of money. B2B, it takes a longer cycle. It's not only longer sales cycle. It takes a lot of support. It takes a lot of these kind of building out the deep, in-depth technologies, integration into the customer's services. So that still takes a lot of money. So I think the creativity is just more of I think more companies coming in, but the fighting will probably be stronger. But winners is still, there's only a few. I think every industry, there's only going to be a few. Existing industry, probably only the top 3, 5 that's actually in the long run stand out. And then just a lot coming in. So I do think within that fight, it does cost. And VC is the one that essentially to almost bring the lubrication to this whole system. So give enough runway for a lot of kind of new technologies to come to fruition at this moment.
What is a good term sheet and what is a bad term sheet for the founder?
Good term sheet, bad term sheet. I think we need to understand. I think good term sheet is from the VCs who understand. I think we should not sit on the opposite side. That's my view of this, right? Alumni Venture actually is one of the most founder-friendly VCs. Actually, we got quoted by one of the magazine ranking as one of the founder-friendly VCs. So
I saw that.
Okay, so that's interesting. So we want to stand by entrepreneurs. I do think the journey is tough. Everybody doubts you. I say not everybody, but you get a lot of doubt. And you get a lot of no's. It's already hard to win the customers, let alone everybody you have to fight. And VC supposed to be your partners, right? So that alignment need to be there, the trust need to be there. So I think the term sheet needs to reflect that. So you need to reflect whether you believe the vision, whether you be able to continue. So we ask for pro rata rights, and that we want to continue to support the company, right? So that's, to us, it's information rights sometimes important to understand what the company is doing. So those some of the rights I think is basic, but we're not going to ask for anti-dilution, huge anti-dilution, those kind of rights. It's just I think that's fundamentally may not be the best interest, but we do want to align. But we are a co-investor in this case, so we tend to I say we align with the lead VCs on many terms, and we can essentially find something on the value add. We'll try to do that.
Beautiful. Ray, how do you handle disagreement with the founders? If there's massive disagreement and the founders want to go in one direction where the VC say, let's go this direction, how is that being handled currently?
I tend to handle in the boardroom, right? So that's typically but I do think that we try to be more advisors to the founders rather than be we want to be there to provide advice, to be able to share our historical perspective, to give them the network they need to reach, to provide the resources they can connect into. So those are the areas that I think where we spend more our time. But when there's a conflict, I do think that in the end, the truth matters. I don't. Everybody have subjective views of the where things should be, but over time, I do think it's a waiting game, right? It's another voting game. Warren Buffett always said that. I think that applies here as well. Initially, it's always a voting game. It's everybody so everybody had their own perspective. I don't think because we don't live in founders' shoes, we don't in there day in, day out, we don't see everything. So we do give founders the benefit of doubt. There's certain things that they see are different from what we see. But we want to give them perspective in a way that where we see historically has happened. We want to see what we have seen in our across the landscape, just because we have done so many investment. There's a lot of lessons learned, and we see how different companies survive or not survive. So we have our perspective. So that's a good thing that we can share. It may not always be correct, like I mentioned. It's the founder timing and the opportunity come together. So each one's unique, but there's certain pattern that we want to share, and that's where we can provide some value to them.
Beautiful, Ray. Ray, which type of founders should not raise money from a VC?
Lifestyle founders. So there's many great businesses, family business. There's many great businesses. You don't need VC. VC is the one that we want to see 10x the returns, right? So you have to run very fast. You have to go extremely aggressive, and the opportunity to be there. It's not a lifestyle that you just build. It's not just a cash flow game. It is something that we're looking to change the world. That's when you want VC money. You're looking at changing the world. You look at something new that is impossible to do and requires a new dynamics, and so that tend to be the VC type of funding. Otherwise, I do think lifestyle business is great. Cash flow business is great. If you can get that and make that work, it's beautiful. Why take? I mean, there's no need to always go with the VC path, right? There's a lot of private equity type of model as well. There's franchise model. There's just so many ways I think as an entrepreneur can express themselves. I do think that alignment need to be there. So are you really looking to change the world? Because that's what we're betting on, right? So, and that's where you should get VC money, because there are certain things that doesn't make money for a long time. That's works for VC, because you look at Twitter for a long time, you look at Facebook for a long time. So there's the social networks beginning. It's in many ways it burns a lot of cash, right? I mean, that just tend to be the business itself. It's okay, right? That's what we see here for hard tech, right? If you're doing a lot of very deep tech, I mean, quantum has not made money. It's so long, right? But it could. I mean, once it works. So that's why I think certain categories is where VC fit the best. And certain areas, I think the founders, if they can bootstrap, they can build a cash flow, they like what they're building, and it's a lifestyle they want. It works well. There's definitely, I think that's the separation maybe.
Mm-hmm. And when is a founder ready to exit? And he's like, okay, you know what? Now I can get a new CEO. I've done my job. I've taken my company to Series A, Series B, let's say a couple of millions of dollars. When should the founder exit? Is it advice coming from the VC? You know what? Now it's time that you step out and we get a new CEO. Happened in the case of Steve Jobs, or let's say in case of Uber as well. What's the dynamics there?
The founder, I think there's the type of founders that may not fit over time. There's certain founders who's very creative, right? We talk about that. I tend to stage, there's 3 stages of the startup or a company life journey. The initial stage is where I think almost like you're in an enemy territory. You're fighting everything is sort of against you. You're sort of Rambo. I don't know if you ever watched The First Blood. That's essentially the mentality. It's almost like you're basically going in and blow up the existing system, right? You need to be very persistent. You need to be believe. You need to execute. You need to. It's sort of like it's individualism. It's a lot of these as people can do things. I think those are the guys who build the initial stage. But then over time, when the company matures, when the product matures, you actually bring in more of a systematic leaders. So think about them as army leaders, right? So you're essentially fighting a battle. You need to come together as a system. You actually have a strategy. You have to coordinate among different teams how to attack. That tend to be may not be the initial founders. So sometimes they feel like they make decision on the fly. But then when your army execute, you cannot do that, right? So it may not culturally maybe a different. Then the last stage is tend to be more about securing your territory. It's no longer just attack, because as you fight through multiple systems, that could be a big after IPO. I tend to see more of that. I mean, or late stage companies, right? Then you tend to be the guys who are almost like police. So they come in, they secure the territory, they maintain the orders, they just make sure that continuous orderly growth, but it's no longer attacking the system. So that tend to be the transition of a company. And then founders, if you are early stage founders, I think if you don't feel like there's a culture fit anymore, or as you don't enjoy the day-to-day more systematic type of approach, you still want to try random things, you can either create a lab in the company that try different things, or you can just finding new other companies to go into or start something new. So that tend to be the exit, I think, for early stage. Then I mean, there's also the economic. When does it make? I do think the life stages of the companies is where those kind of founders find whether they can continue to grow the company, or many ways they also find a partner along the journey, right? You see Mark Zuckerberg find a partner, Joe Berg comes in on Facebook, you find Google's founders find the same thing, as you need mature management, kind of sort Eric Schmidt, right, come in. So you tend to have this kind of partnership as well as you grow as a founder. You may be the early stage founder, but over time you find partners that somebody can come in together, help you to scale the system side while you still maintain the creative side. So that doesn't mean the founder needs to exit. It just means they need to build a team. They need to recognize their weakness or certain areas they may not be good at, or they don't even enjoy, that they want to partner with. That kind of partnership mentality, I think, is also very important as the company grow, to be able to partner with the right people and to be able to bring the company to the next level.
Which type of companies, Ray, are going to succeed in next 5 years?
I think we see the movie before in the internet age, right? So for example, Amazon versus Barnes and Noble, right? So Amazon is more the internet native, and Barnes and Noble more the internet enabled. We see that. So sort of that. I think that's where this kind of play out, probably in the AI world as well. We see a lot of companies that essentially are built as a human as only driver, as a decision maker. But I think we are into the AI age, what we call AI native, AI first type of companies. These are the ones that actually build on the language models, build on the proprietary data, build on the agentic infrastructures that tend to think based on the almost like a human AI collaboration mode, or sometimes let's define the outcome, let AIs try to optimize it. I do think that's create a new paradigm in a way that how the company can operate, company can work better, and that's tend to be I think from a venture perspective, become very interesting in the next 5 years. That's what we're building on. That's what we're investing into. We have a what we call AI first fund. That's all we look at. It's like, is there something that completely different that because AI is a new paradigm shift almost to a certain degree? Is there new opportunities, new companies, new space that created because of that? And let's invest into those.
There are a lot of services companies founders who are now trying to build products in the AI and trying to give the services via AI, like they're doing a product in the front and services in the background. Is that going to work?
I think it does, but it takes multiple iterations, right? So we call these high touch model. So you'll see the high touch outside, you'll see the high tech inside. So high tech, I do think that's the first time AI is be able to become a co-worker or replacement of their labors in many industries. But my view is that it's similar to autonomous driving, right? It's from level 1 to level 5. It takes many, many years to be able to, for the AI to complete function by itself. So if you think about level 1, essentially humans still make most of the decision by AI's assistants, right? But over time at the level 3, kind of you let AIs almost execute themselves, but you still need to supervise it. You need to understand it. You need to be able to control it. At the level 5, then becomes AI become most of the activities and make all decisions except exceptions, right? So with human don't you get involved. So I think that's where I think some of these will come in as well. Maturity will build over time. It's not coming 100%, but it is a new paradigm. I do think it makes a lot of sense just because in many ways we see AIs become this kind of very, I mean, in certain areas, it's probably as good as human, if not better to a certain degree. And I think there's significant cost advantage of using AIs. There's a lot of new ways to look at what it can do and discover ways that human may not think about. I mean, you think about even AlphaGo, right? AlphaGo actually comes in and to do certain moves that human is puzzled to human, right? Why does do that, right? So I think there's many ways now with this kind of new iterations of this kind of partnerships with AIs. It is very important to have that together and the new companies to be able to take advantage of that.
Brilliant piece of advice, Ray. Last few questions, rapid fire for you. Sure. Cold email subject line that gets your attention.
I look at everything. I don't think there's cool. I look at all emails coming in. So yeah, there's no cool headlines. The headlines I say is, I don't know. There's so many marketing headlines. It doesn't matter. To me, I look at all emails. Yeah.
What do you see first, product or deck? What do you want to see first, product or deck?
I see deck only because I don't have enough time to go through all the product.
Mm-hmm. Favorite diligence question right now?
What unique you're building and how defensive that is.
Mm-hmm. One founder superpower you wish more of your portfolio companies had?
Customer focus.
Brilliant. Ray, this is fantastic. Loved the conversation with you. Thank you so much for your time today. I really enjoyed the conversation. Beautiful wisdom point. I think a lot of founders watching this can learn from this, what they should be doing in the future, how should be investing their time, how to build companies, how to scale their companies. Really appreciate your time today. Thank you so much for your wisdom and authenticity.
Thank you for having me.
Thank you very much.